Hello, welcome to our Chapter 2 video lecture for Principles of Financial Accounting. Chapter 2 talks about transaction analysis. First, we're going to explain what a transaction is. It is basically any event that has a financial impact on the business. It can be reasonably measured, and it's basically an exchange. So what the accounting record does is record both sides of that transaction. First, we need to know that we're back to differentiating, right? So we need to know what account has changed. This is our accounting equation: assets equals liability plus owner's equity. So we just need to see how that transaction impacted our equation. So for example, if we paid cash to employees, then our asset would go down, cash, because we paid it out. So assets, we mentioned previously that they provide a future benefit. Cash is any type of money that is included in your bank accounts and, CDs and checks. Accounts receivable are basically a promise from your customers that they will pay the amount of money that you've agreed to for your rendering of services or the sale of the goods. Notes receivable is also a promise, but in this case, there is a signed note document. In an accounts receivable, there is usually no document other than the invoice, right? You invoice the customer for tax preparation, whereas a notes receivable has interest associated with it, and there is a signed promissory note. Other assets include inventory, whatever goods the company sells. We'll talk about different types of entities. If you recall from our previous discussion on the financial statements, that we have different types of entities and customers, and then inventory. Prepaid expenses basically are paid in advance, and it usually is insurance. You pay insurance for a year, or rent. You pay rent at the beginning of the month for usage throughout the month. Land is what you use to acquire land. Note land is not depreciated. We'll talk more about that. Buildings is just that, when you purchase a building, and any other furniture, fixtures, equipment, leases, etc. Now, liability, we mentioned, are what we owe, and accounts payable is usually a promise to pay debt, and this is usually to vendors. So basically, if we continue our Gap example, Gap actually buys items, right? From maybe they have to buy fabric and sewing machines or what have you, and then basically accounts payable would be those promises to pay vendors. Similar to notes receivable, notes payable is now you as an entity are signing a note and promising to pay an amount. Accrued liabilities is basically you've incurred the expense, but you haven't paid it. And you will see that accrual accounting, which we will talk about in a subsequent lecture, accrual accounting is basically not cash-based. You record the revenues when they are earned, not necessarily when it is paid, and you record the expense when it is incurred, and then you accrue the liability, which is the cash portion of it. Owner's equity are the owner's claim or the residual. Common stock is an ownership of stock. You may also have preferred stock where you have voting rights, and we will talk about that in a later chapter. Retained earnings is your beginning balance plus your net income less any dividends, and then that retained earnings ending balance is also the statement of retained earnings. And dividends, note it is declared by the board of directors, and when that is declared, you have a liability of dividends payable to give the money to the shareholders and distribute them. Now, part of owner's equity is revenues and expenses, which is recorded on our income statement. Recall, revenues minus expenses equals our net income. Revenues are basically, they increase your stockholders' equity based on the fact that you're selling goods or services. So when Gap sells you a pair of jeans, that's their revenue. Expenses decrease that stockholders' equity. So let's stop right here and go through this exercise. So pause the video here and complete the exercise. So basically, we're naming two things that increase Whole Foods stockholders' equity and decrease. So an increase, we could say, is the sale of stock and net income, and a decrease would be dividends and expenses. So now moving on to seeing the impact of the business transactions on the accounting equation. We are going to start with an example, and now let's say that Freddie Krish opened the auto service store in April. So now our first transaction is he and some friends invested $50,000 to open the business. And what they got in return is common stock. So in this case, our $50,000 is going up. We got money, and our common stock is going up. We issued the stock. Now our next transaction is we purchase land, and here we pay cash. So in this case, we are reducing our cash by $40,000, and notice this is on the same side of the equation. So this transaction hits both on the left side of the equation, and we are exchanging one asset, cash, for another, land. Our third transaction is we're buying supplies on account for this auto store, and now we are agreeing to pay the $3,700 within 30 days. So in this case, we have supplies, that's an asset, and now we are again trading one asset, we're basically taking that asset, and now we have our accounts payable that we have this promise to pay. Notice it's not receivable. Receivable are from customers. That's money's coming into us. Here we owe the money to the supplier. Now we received $7,000 in cash because we provided services. So since we received money, our cash increases by $7,000, and so does our equity because it's part of retained earnings, revenues in this case. Now we have our next transaction, which is we repair UPS trucks, and now UPS promises to pay us $3,000 within 1 month. So now we have UPS as our customer, and we have an accounts receivable that they owe us the $3,000, and basically we performed a service, fixed the trucks, so now that is also service revenue for us for $3,000. Now we pay $2,700 for expenses, where in that $2,700 we pay rent of $1,100, we owe our employees $1,200, and utilities for $400. So in this case, the full $2,700 come out of cash, we paid it, and now you see we record it into 3 separate accounts: rent expense, salary expense, and utilities. Very typical. Either way, it's an expense, which is part of our income statement and reduces our retained earnings. We now pay $1,900 on account, keyword, which means to make a payment towards our accounts payable. So right here, what we owe, this $3,700, we're paying $1,900 of it, and notice we are recording now the reduction of this balance here. So we're taking out our accounts payable, we're bringing it down because we paid it. Now, Freddie, who is our major stockholder, he paid $30,000 from his personal bank account to remodel his home. In this case, we do not need an entry. It has no bearing on the business. Remember our entity assumption? Here we are recording only the transactions that relate to the company. And in this case, this is his own, Freddie's personal information, so it doesn't have any bearing on the books or the accounting records of the company. In transaction 9, we perform services again for UPS on when we did these services. Now we collect $1,000 from UPS. So you see here again, this is only the 2 pieces of the equation that are, we're taking one asset, cash, which we received, and now we're reducing our accounts receivable because UPS owes us now less money. So now their balance would be $2,000. They paid us $1,000 of that 3. Now we receive $22,000 from the sale of land, and which is thankfully the same amount that we paid for it. So in this case, we take our land that we sold, $22,000, we subtract it in cash. Again, notice this is all on the asset side. We're exchanging one asset for another. Now we declare dividend, key point, gives us that it was incurred, doesn't matter, and pays the stockholder $2,100 cash. So in this case, you see cash goes down and our dividends. And remember, dividends is part of retained earnings. Remember, beginning balance plus net income minus dividends equals our ending balance in retained earnings. And then you see, let's go back to that. then you see our totals. And the key is that they both equal $57,000. So perfect. We've recorded all the transactions. At least our debits and credits equal. Our left side equals our right side of the equation. So our financial statements, if we go back here, we will see, and our financial statements are produced right here. And you see the 7,000 gives, and the 3,000 give us our 10,000. And if you'll note, you see those pieces here as our revenue transactions. And then you see the expenses when we paid, so there are $2,700 that we paid. Here we're recording it separately, rent, salary, and utilities expense to get to our net income. Notice if we go back, we just see those pieces. So what we are using is this piece right here to complete our income statement. Notice I left dividends out because that goes on our statement of retained earnings. So you see our statement of retained earnings, our dividend. And you see this net income of $7,300. We received that here from our income statement. And notice the beginning balance of 0 because we started the entity. They told us that at the beginning. So we now have our ending retained earnings balance of $5,200. And if we scroll back, we see our $5,200 right here. So here is our balance sheet now. So this is our assets equals our liabilities plus our owner's equity. So let's look at our cash account here. We have $57,000, and if we go back to our transactions, that's our $57,000, where we have cash at $33,300, accounts receivable at $2,000. Our supplies at $3,700 and our land of $1,800 because we noticed we had 2 transactions in land. Moving back to our balance sheet, we see the 57, and here is our land, cash, accounts receivable, and supplies. Notice we only have $1,800 in accounts payable, and notice we have our retained earnings that we calculated. And the only other transaction that came from that piece was our $50,000 from common stock to get to our 57. So let's go note so our accounts payable and our common stock. Let's get back to here. So here is our notes payable and our common stock, our accounts payable, of $1,800. These two amounts are added, and then our common stock, and basically that's it for those pieces. Pardon all the scrolling back and forth. So at this point, let's go over this example. We opened a practice, so that's the key here, and our first month of operation was February, and the business title is as such. And now we want to analyze the effects of the transactions on this entity. So very similar to what we went through. And then we invested $100,000 in the business in return for common stock. So we take cash and common stock. Those both get added. Now we borrowed $50,000 on a notes payable. So our $50,000 gets increased and our notes payable gets increased. And recall the notes payable has a promissory note. Now we paid cash. Cash is always the easiest item to consider. So if we look at paid cash for land costing $105,000 where we want to build an office building on. So here we paid cash, so this is going down, and we have land. Again, note that it's all on the asset side. One is down and one is up, so the net effect is 0. So now we purchase supplies for $1,700 on account. Once you see that, you know that there's not cash involved. So since it is on account and we purchase, this is our accounts payable for our vendors. And here we have our medical supplies, which is an asset that we are getting. Now we open for business, so that's fantastic. We have no entry is associated with that because there is no financial consideration. Really, a transaction didn't happen. This is mostly for your information. So now we're in business. So Dr. Luke, we earned service revenue for $5,600 where we received cash for half. So in this case now, we have all the service revenues recorded in retained earnings because that increases, but notice half and half. Half is cash and the other half is going into accounts receivable. So both of these amounts equal to 5,600. We need this to be in balance, right? And our service revenue. So this is a compound entry. It has more than just two lines, right? We're recording cash, accounts receivable, and service revenue. Now we paid our employees $2,300. So since we paid them, we have to reduce our cash. And here we have salaries expense. And now we treated patients and we received $1,500 of cash at the time of service. So in this case, we are getting $1,500 from our patients and we are earning revenue again. We met them. Now we're going to pay office rent of $1,000. So that's great. Our cash is reduced. We're going to reduce our cash by $1,000 and record an expense, rent expense of $1,000. And now we paid $500 on account. So from our accounts payable balance here, we paid $500, and again, cash goes down. And notice our totals, just as before, they equal. Fantastic. So our assets equal our liability plus our owner's equity, and these totals are what we use to produce our statements, financial statements. So let's see how much are our total assets. If we go back, we see our total assets are $155.5. And then how much does the business expect to collect from patients? So this is our collection, which is our accounts receivable. And how much does the business owe in total is both of these amounts, right? So they owe accounts payable and accounts receivable. I'm sorry, accounts payable and notes payable. Once you see the word payable, that usually signals a liability. So in this case, most students would get confused and just say accounts payable and forget about notes payable. Both of those are what we owe. And what do we own? How much do we truly own of the assets of the entity? And here we see it's $103.8, right? So we our retained earnings, our net income, our equity side, right? These are our liability sides of the equation, and then this is our equity side, common stock and retained earnings. So we add the two of them, and we get to our total residual that we own. So how much net income or loss did we get through this first month of business? And you see that right here, right? So the expenses are removed, and the 5,600 and the 1,500 are our revenues. So this will conclude this video.